It takes like $100 to $300 million to build a massive business, like to be able to take a company public and build the Figma of tomorrow, or, the Amazon of tomorrow, whatever the example is. It will take you real dollars to get there, because the way to get velocity in this business is to...
How can you find the startups that are going to be breakout successes, but before it's obvious to the rest of the world, before any of the traction, and definitely before any of the press? Today's guest on Founders and Builders is Hussein Kanji. Hussein founded Hoxton Ventures, and he's known as one of Europe's most influential tech investors. He's backed companies like Deliveroo and Darktrace long before they were household names. And I didn't realize before we recorded together, but I think at one point Hussein actually owned a chain of bakeries in central London. I just thought that was really cool. In today's episode, we're going to cover how to spot and back founders before the rest of the world sees their potential, and how, though Silicon Valley may have led the first wave in tech, Europe is just getting started. I'm Joe. This is Founders and Builders. If you enjoyed this episode, don't forget to smash subscribe down below. And now let's get into it. You set up Hoxton Ventures, what will be 12 or 13 years ago now, with the thesis that you wanted to bring a Silicon Valley mindset to European investing. What did you see at the time?
So this is a long time ago now. Europe was still it is a vibrant ecosystem now on the tech side, which was not the case. I remember way back then, you try and talk to people about this European opportunity and be like, give me an example. The only example you could really come up with is Skype, because that was the only example of a company that an American would kind of know. So it was very thin on the ground here, but it was kind of sort of obvious to me that was going to change. It was going to change for a whole bunch of reasons. There were people going into the Bay Area. The first YC cohort was Go Cardless from the UK. It was Tom, who now is back at YC after doing Monzo. There's a group of people who are going over there. There's a bunch of people consuming the blogs and the information. The world is, again, much more global, so this information is becoming much more porous. And the ambition level then was rising here, because you could see what your peers and contemporaries over there would do. And then you had distribution, the App Store, you had Facebook, you had mechanisms to actually get an audience and go all over the world, which you just couldn't do 25 years ago. It was too hard for a European. And so I was on the back of all of this, there'll be more stuff here. And then I think the more stuff here needs to go over to the US, because I think you have to win the American market if you really want to get this scale. And then you look around the ecosystem, and this is circa 2010, 2000. We formed in 2013, but we kind of started the idea work in 2010, maybe late 2010. And you looked around, and most of the people who are here had raised a fund in the peak of the .com. And then unfortunately, Europe has always historically been late to the curve. It's the curve starts in the US and then it comes over here. And so, the .com started and then it came over here, and there's a frenzy around the .com industry, and funds got raised to take advantage of this. But then the bubble collapsed, and, you were in this dire period from 2001 onwards. And most of those funds now, 10 years later, 'cause it takes 10 years for people to figure out if funds are good or bad, we're now going out of business. And people don't even remember these names, Pond Ventures, Eden Ventures. They're footnotes now in history. But those are the seed funds in Europe. And they were dying or going away. And then the big funds were Index and Accel and Balderton, and they were going up market and trying to do bigger deals and not stay away from this weird early stage market, because there wasn't anything in the early stage. They wanted to buy family owned businesses and commercialize them, professionalize them, and be able to take them public. I was all this is a backdrop for an upstart to go do. And we weren't the first upstart. The first upstart was Pro Founders. It was Brent Oberman and Michael Birch. We're we're going to go do this as founders, and they ran Founders Forum, going to do this. And then we were in that first wave. Connect was in the first wave. Pro Founders, Passion Capital was in the first wave. And I think many of us caught the wave. I think we caught the wave a little bit better than some of the other folks. I mean, our companies just became much bigger, and so they can give you a right to exist. And then, next thing you know, you're on a few different funds, and you're kind of then trying to compete now at the level of the bigger guys. And now the market is very filled in. There's a lot of people in this market. The US funds are here. The funds are regional, have gone pan-European, Crandom, North Zone, Holtzbrinck, or HV. There's just a bunch of activity here, and then there's like probably 30, 40 times as many companies here. Like, so that there's like a real vibrant market here.
Mm.
I don't think that's gonna change. Like, I don't think that's gonna hollow out. I think that's gonna keep building and keep growing.
You mentioned first time we spoke that about half of the companies you invest in are in enterprise, let's say enterprise software, enterprise AI now. 30%, I think you said, were like deep tech. So you've done everything from like, rare minerals being generated in a lab, nuclear energy investments, and then about 20% on the consumer side. How do you identify which company is the right company for you in Hoxton to invest in?
Yeah, so we have a simple thesis, and we don't always get it right, but we try and stick to this thesis. Is we think these big asymmetric outcomes, like the big new markets of tomorrow, are generated when something has changed in the market, and the something change could be cultural, like that could be a driver, is often technological. Like there's something that you can do with the stack that's today that you just couldn't have done before. Um, yeah, sometimes it's regulatory, like the markets have opened up because the regulators have opened up. A lot of the fintech stuff was probably along that theme. And when those markets open up like that, there's usually sometimes they get captured by incumbents if they're too close to home, and sometimes they get captured by greenfield. Like sometimes they are greenfield, so they get captured by new companies because no one really knows. It's kind of the blind man and the elephant, right? The shape of the new market. You don't really know what the new market looks like. Like this morning, I had breakfast with a friend of mine who's an early angel slash like seed investor in Kalshi, which is like Kalshi and Polymarket are the predictive betting companies. And this predictive betting stuff has been there for like 20, 30 years and has always been kind of niche. And then something changed culturally a few years ago. And so these new markets then kind of open up and it's not captured by the incumbent because there is no incumbent in greenfield. And that's what we're looking for is like what's changed in the ecosystem technologically or culturally or regulatory that allows the company to get born. And then if the company gets born, is this one that's born on the European side of the pond going to become the big global winner? And historically, that's not necessarily the case, but it is like increasingly turning out to be the case. It's not every single time, but it is like no longer like 0.1%. It's probably like 10, 15% of some of these companies or some of these themes end up getting captured by the European company. And then that becomes a dominant company. And I would say that has to then become a global company, not just a European company. And so this bridge back to California really matters. I think the bridge back to California also really matters because I think if you're looking at these companies and you don't know what's going on that side of the pond, it's really hard for you to discern, is it really best in class or is it going to be the also ran? It's like we did a robotics foundation model and there's a bunch of money going into robotics right now and at the AI level. And if you don't have the compare and contrast ability of what's going on in the Bay Area, then it's really hard to know if this group that's kind of coming out from Europe is actually really well equipped. Otherwise, you're building like the European and by the way, there's a whole trend of people trying to build like the European versions of things. I'm a little bit more skeptical whether those things really create like super long-term value. I can understand them in like things like defense, but like generally it's a winner take all market. We did this long time ago. We did this like chart of like in social networking. If you chart it out by enterprise value market cap of that entire industry, and there were a whole bunch of companies, like people forget this, like Bebo was sold for 850 million
R.I.P.
bucks.
Bebo. I used to love that site.
It was like the dominant one in Ireland, and it kind of came across the pond here. That's what got Michael Birch, who founded Pro Founders, the money to be able to do that. He also built the Battery in San Francisco because he went to San Francisco and he was like, there's no Soho House in San Francisco, so I'm going to go use my money, which is this Bebo money, which he'd sold to AOL for 850 to go build the Soho House replica which has now become like a huge thing in the Bay Area, right? It's the Battery. Everyone knows what the Battery is. So like, these things are positives for the entire ecosystem in many ways when people get wealthy this way. But there was 20 in Spain, there was like Bebo here, there was MySpace. Like, but if you chart it out, it's like a big giant square, and then you shade in the areas for like how much market cap each particular company kind of captured. The entire square visually looks like Meta. Like everything else is kind of sort of a rounding error. And so like that's what you're looking for, right? You're looking for this new category and the winner of the category, and the winner of the category takes so much of the overall value created by the category. And if you did that same thing for music streaming, and you did the same kind of shading exercise, Spotify would take a huge percentage of that market share, right? Of that kind of value kind of created. Then the number two would kind of be like Apple Music, and number three would be Amazon, and they're very distant number two, number threes compared to Spotify, and there's no other company that's kind of come in, to be able to compete. Deezer in France, but like it's not the same. It's not in the same league as a Spotify. Pandora for radio in the U.S., but like it's a footnote in history again. Like you don't think about it anymore. So like these things happen, and they can be European outcomes, and we're trying to find those. And we don't think they happen in the same industry time and time again, because we are kind of we're the continent that produces the exception to the rule. Like you could maybe kind of sort of argue Spotify, and I don't think to be even remotely accurate, but like a lot of popular music is produced by Swedish producer. There's like one Swedish producer at the helm of many of the hit songs so you could like kind of maybe say the reason why Spotify worked in Sweden is because like they have this tradition of producing world-class pop music. But like, that's not the reason. It just so happened to be that Spotify figured out the user interface, figured out how to deal with the labels, started in Europe, kept going in this industry when no one else really wanted to touch this industry, struggled to raise the first few rounds of capital because it wasn't an obvious thing to do because you didn't know if you were going to get the contracts, and then turned out to be the big winner. And obviously the founder is great. I was able to kind of guide the company all the way through that kind of very, topsy-turvy journey, right? Because these things are never linear. But they do appear in Europe, and like that's what we shop for. I think where we get it wrong sometimes is like something looks really good, is a good idea, it's a really good team, it's a really good founder, and then we kind of make a little, like we kind of relax some of these constraints a little bit. Like, is it really a new category? Is it really a new market? Is it really going to become a big market? Is it really going to become the winner in the market? And that's where we've probably been burned historically. But I think we try and hold to this like pretty well. We also make the inverse problem. Sometimes we see all those characteristics and we talk ourselves out of the deal, which is like even more painful and punishing in many ways, because like then you miss a bunch of the value capture. We spent weeks talking to Tom at Monzo when it was Mondo. Well, we started talking to Tom when it was still at Starling before he got fired by Ann or left and took the whole team. It's obvious in hindsight that there's like a regulatory opening to build that company, and we were not convinced about the regulatory opening, and we were also not so convinced whether it would be a UK bank or a global bank, and we got trapped by our own thinking around must be global, right? And didn't end up writing the check. Should have written the first million. Would have made a lot more money. We missed Revolut entirely. So like, that one is less of it's a bigger lamentation. Like, why did we miss it? But like, it's much like it's the ones that you've spent real time with and then you've said no to, like, that they're really kind of hurt. But generally that's our framework for thinking about things. And it's taken us into a lot of deep tech investing at a time where very few people were doing deep tech like 5 years ago. Because I think at that time in the ZERP era, people were doing like Amazon roll-ups and scooter companies and like grocery delivery companies with like no unit economics. I'm trying to think of what else was like. Hop-in was probably
Crypto was big.
Crypto's big, but I think crypto is a new market. But I think if you're not native to crypto, it's really hard to do it well. And I think crypto is one of these weird things where even as an investor in crypto, think a venture style investor, you have to think like a trader versus think like a fundamentals person.
What's the difference?
So I think for a trader, you have to think about the exit like you have to trade out of the stock. You're holding an asset, like you're buying a security that you're also then going to trade out of. Whereas I think for us, we think about how to build a company, I think a very durable company, like which you would hold for years and years and years and years. Like there's a rumor, I don't know if this is true, but I think it's a reasonably well-known thing that NVIDIA, when Sequoia distributed the stock, the Sequoia partners kept the stock that was their carry portion of the stock and held on to it, right? Like you want to hold NVIDIA from 1993 to 2025. Like, yes, crypto's been big, but like in that ZERP era, we kind of avoided a lot of the consensus wisdom. And we're like, there's lots of really good like science coming out of these labs in all across Europe. And it is not science where there's like research involved anymore. It's like ready for commercialization. Because normally with deep tech, it's like a super long cycle to get product out the door. But in some of these cases, the product is like, these are like 6 months, 12-month, 18-month development cycles, and product goes out the door. We did this rare earth minerals company It can make rare earth minerals from scratch in the lab. Can't do all of them today. Can do a handful of these things, but they can make them. Like you can, we had national labs and test results from national labs. Like there's physical stuff like that we can make. We have like a pipeline of customers. We're just about to sign our first contract with like a really big customer. Like it's very, and like it's a 80% gross margin business, maybe 85% gross margin business. It's a new market, right? And then you can make these things in the lab. It's a super important geopolitical market because you can't get a lot of this stuff anymore because it mostly gets done in China. It's either mined in China or processed in China. It's like there's some real tangible benefits and there's a reason for people to want to buy from a young company. And, you know, there is no incumbent because the incumbent is effectively all in China. Like, does this have the characteristics? We will know 10 years from now. Does this have the characteristics of becoming a mega business? It feels like it. Like, yeah, that's so we write the checks for those. And we found that was a lonely endeavor 5 years ago, but that's no longer. I think other people have realized you could make a bunch of money on deep tech. And
You mentioned something really interesting, Ellie. You said a lot of these opportunities come about because there's a change in regulation or a change in culture. How can you get ahead of that curve, like before the fact, before the information's priced into the market and all of the venture investors catch up?
and you're talking to lots of people. The regulatory one is easier because, you know, like when the FCA changed the way, like they lowered the banking requirements. Like there's an actual change, and that crystallized a lot of banks to get formed in the UK. They wanted more competition for the banks, and they lowered the capital requirements to set up the bank, and they lowered the regulatory requirements to be able to run the bank. So you used to need a lot of money, like 50, 100 million, like to be able to get these banks off the ground. Then you needed 1 to get the preliminary license, and then 10 to get them. Like that you can get. I mean, you're constantly in the flow of information that you can figure out. The cultural ones are harder. Like, how do you know that the culture has shifted? Or like betting markets, which have been going for, like I looked at a betting market startup when I was at Excel 20 years ago, you know, never really took off. Why is it going to take off in the Trump election? Like, you know, those are genuinely hard, but they do happen. But they're hard, right? Because you can't be as analytical about them. You have to have a feel for them. And I think good consumer investors figure a lot of this stuff out. Enterprise software investors are less in tune with some of these kind of cultural shifts. I think some of the VCs I know have said, like, if you have like 12, 13, 14-year-old daughters, that's a really good way of staying in tune with what's going on culturally among the newer generation. Like, that's a good window as to what's going on. I don't have a 12, 13, 14-year-old daughter, so like I'm a little bit more in the dark on these kinds of things.
Last time we spoke, you said you spend most of your time doing one of two things. One was coming up to speed on new spaces. You mentioned rare earth minerals from scratch, nuclear energy, which we talked about before. But you also said figuring out how to scale a company. If I could double click onto the first one,
Yeah.
how do you use the people that are already in industry, already working with these products, these end customers, to be your like domain specific experts? How have you built that kind of I want to say like army of thought leaders around you that can help you go deep where you're more broad?
Yeah, it's double-edged. So I think the longer you work in this industry, and our industry is like very well networked. Like it is a very small, it's a big industry, but it's a very small group of people that are all very socially connected to each other, you know, no more than 2 degrees usually. And the longer you've been in this industry, the more of this you kind of have around you. So it's easy to call upon people that you've done business with before. You might have worked with them in a cubicle, you know, next to them, like, you know, in a previous job. Like you just end up building all these relationships that are useful. And I think it's what makes it's what makes you a good investor. Eventually you get a little bit too out of date, and then it becomes harder to become the investor, because so much of our business is like information, like in judging information. So you have to be kind of in the flow. And so we do a lot of that. I would say the experts in the industry sometimes are too narrow-minded about what is and isn't possible, because there's a certain amount of naivete you need towards building one of these things. There's a certain amount of lucky breaks you need to catch.
They kind of overfit to what they've seen before.
So again, look at the Spotify example, right? If you talk to most experts in music, including people probably who worked at record labels, you would probably hear the answer that there's no way that the record labels are going to do a fair deal. And, you have to kind of catch a little bit of a break. And I think in Spotify's case, there was so much piracy that the labels had to react some way and enable some positive
Mm.
like
Your
thing.
hand was almost forced.
Yeah, but like I think it was not easy, I think, for Spotify to get its first labels, and I don't think the first label contracts were nearly as fair for Spotify as they probably should have been. Um, so you kind of have to believe in that, like, being on the right trajectory, a lot of the pieces will kind of fall into place. And I think if you're an industry insider, especially if you're a very deep industry insider, like a true specialist in your field, sometimes it's hard, right? Because you have too much scar tissue, and you just know what's actually possible, and you can't suspend disbelief as much. So our job as investors is to talk to a lot of these people, and then kind of see around the corners a little bit, connect all the dots, and figure out if it's, like, worth taking the bet or not worth taking the bet. Sometimes it's easy. Like, in the case of the rare earth stuff, like, we didn't know anything about rare. I mean, we knew what we read in the newspaper. Like, that was about it. Like, didn't know what these things were exactly used for. We didn't know what the properties were. You could get up to speed on all of that kind of stuff, and then you could have experts look at, like, the chemistry basically to help you get it, up to speed. And you in this country, you have national labs that actually do some of these testings, and you can look at the test reports, and you can convince yourself, yeah, it actually does what it says it can do on the tin. Still have to suspend disbelief, is like it does it for like 2 or 3 things today. You should be able to extend out the same framework of thinking to be able to do like 8, 9, 10 things in the future. If you can do all of that, then you have a really big company kind of in the making.
Mm-hmm. Super, super quick one from me. As you know, every week we ask our listeners what is one tool that they couldn't live without. And this week, everyone's talking about N8N. What is N8N? Well, if you haven't used it before, you can build products and workflows that connect anything. You can sync data between your CRM and your email marketing tool. You can even build AI agents. What's super cool is that you can self-host it, so all of the data stays yours, and it also supports adding code when you need. It's a great way to start building, even if you're not a software engineer. If you're interested in learning more, check out N8N in the show notes below. And for now, let's get back into the episode. How has the use of AI, and I've seen a lot of tools like Harmonic, for example, for VCs, like for those that don't know, it's like Crunchbase, but on steroids, helps you source and maybe do early stage due diligence on deals. How do you think about how your edge as an investor has changed over the last, let's say, 5 years?
So we did a lot of AI experimentation in the firm, and we wrapped up some of it about 6 months ago, a year ago. And we actually had a team that we were funding kind of out of our management company. So it wasn't an investment because it didn't make sense as an investment, but we were kind of funding it out of our own bills to who was looking at this stuff. And they were doing all kinds of, like, it's basically fancy regressions, right? Figure out what's actually like the thing that's actually, the identifying factor. I'm reasonably convinced, having seen a lot of their data, and they were tweaking the stuff and they were physically in our office. It was actually really easy to talk to them. That these are great engines for follow-on capital and for Series B, Series C, where you actually have some data and some signal. I think for the early stage data, the signal is largely from the profiles of the people, which I think is good. And the Harmonics of the world, I mean, but to be fair, you could use LinkedIn Sales Navigator just take more time, or you could use Harmonics, which are like an automated version of LinkedIn Sales Navigator, to find out who are these kinds of founder types that are going to, like, the schools that they went to, the places that they work, the rapid rise in seniority, like, gives you a little bit of a tell. I'm not always convinced that all of the exceptional founders come from this. I forget what the term is. Like, it's like these are the hot founders, but like there's an industry term that people are using. It's not generational. I forget the name of the term, but like, that these are the people who have like the highest stamp of credibility in many ways, and the ones that everyone's kind of seeking. Like, you look at Will at Deliveroo. He went to business school, Wharton, went to, smart guys. I don't know what he does, an undergrad at Northwestern. I think it was like physics or something. He was a hedge fund guy. But like his view was food delivery was fundamentally broken in London, and he was going to go fix it. And that's what he wanted to do. He'd never been a technologist before, right? Didn't write code. But he was going to will this business into existence. From the early days, he got on the bike, like he went door to door, he signed up the restaurants, I'm not so sure the harmonics of the world would capture someone like him. We have another founder who's doing like AI protein discovery, or drug discovery using proteins, and like, superstar like researcher who then took some time off and became a photographer for National Geographic. So if you type his name into Google, you'll see mostly his photos. And then went back to the science and then assembled like a little team of like people just kind of like him. I'm not so sure, but like no pedigree. I mean, obviously like high academics. I mean, becoming a photographer for National Geographic is like, I mean, that's like elite level, like that's elite level photography, right? Like you don't get to shoot for those kinds of things if you're not a good photographer. So very, very good at what he does, but I'm not so sure that signal would necessarily be captured by some of the AI systems. But I think if you're not using some of these things to keep abreast of who's starting companies, then you're playing at a huge disadvantage. But I also don't know, if you have these systems, you have a huge competitive advantage over like basically the bar for everybody just raises, everybody incorporates these things in one way or the other, then everyone's using effectively the same tools. And the job's just gotten a little bit harder because now you're competing at a slightly higher, like you're competing, but you're competing, it's less sleepy, right? It's more dynamic, but you're still competing with the same people.
Yeah.
I think the AI stuff for later stage things feels like a bit more of a, like, I don't know, we do early stage, like we don't do late stage. If I was building a late stage firm, I would be very heavy on the AI side. Goodwater's done some of this stuff, and I know that they detect stuff. They take like credit card receipts, like kind of like what a hedge fund would do, like a lot of information flow. And I know that they've called me up a couple of times being like, we heard good things about X. I'm like, how'd you find that out? And like, it's their internal engine. They've been doing this for like a few years. Like, so I think if you're doing a late stage firm, you can do it because you actually have data. I think if you're an early stage firm, not so sure the AI thing is going to find, and we'll see if this rare earth mineral company goes anywhere, but like, I don't know if it's going to find that company.
What are the principles that you've developed as an investor over the last 12 years that have really changed or, let's say, matured over time?
I mean, this general framework that I gave is a big one. I think we have become more strict on the move to the US or to the expansion into the US, in places where we've had that fork in the road and the companies have chosen not to do that. Like the common thing here is the founder, and assume for a second it's a guy. It doesn't always have to be the founder of the rare earth minerals company is a Oxford PhD and a woman, a female founder. But like, a lot of these guys are guys. I'll just use the word he. They start here and they want to do the US, but they don't do the things that are required to go to the US. And the biggest thing that you probably have to do is relocate. And if you have a family or you have kids or you have a better half, then it's a tax. And I think when you don't do that, you don't capture the US nearly as well. And people think they can do it from here or they go back and forth, but it's not the same as physically being there. And so much of this business is serendipity. So if you're physically present in a place, like you end up getting exposed to things that you just wouldn't have been able to predict. And if you're here, it's hard. And then the follow-on money isn't as easy. It's much easier than it was like 5 years ago. It's still not as easy, And so like at these forks in the roads, I think we're a little bit more strict about like, do you really want to go and expand into the US market? And I think if you don't expand into the US market, it's very hard to become like really, really big.
Who are the companies that have really stood out to you, started in Europe, but done an amazing job of expanding to the US and kind of like owning a category?
In our portfolio, Darktrace definitely did this, and they did it here. So their biggest headcount was in the US, but they ran that whole team from here, and they did it like super admirably. And it got to like 700 plus in revenue, right? Which is like that's a real number. Like we talk about like companies going from like 0 to 10 or 0 to 50, like to get to 700 is like a big deal. And who else has done really well? I mean, I think Hugging Face has done it really well here. They started in France. There's a bunch of these examples now. I think UiPath did a phenomenal job, like probably the best in this. The growth rates for like UiPath were like ridiculous. I forget the exact numbers, but it was like 1 to 10 to 50 to 150. Like it was kind of in that order of magnitude. It was like that's like exceptional growth, even by AI standards, like in the growth that you see today with some of these things. UiPath was like really phenomenal.
Mm.
But they physically moved, right? They kept engineering in Romania, but Daniel moved over to New York and then built a team in New York.
Mm. Yeah, and UiPath, you mentioned, obviously dominated RPA at the time, where it was pre these kind of probabilistic models, LLMs that could just kind of sit and listen, and it was all very rule based. But it was automating, and software was eating many of the human workflows at the time.
Yep.
But it really played well into market timing. So my next question I'd love to ask you about is, how do you judge how long a window of opportunity to invest in has left to, when the ship has sailed?
Yeah, so RPA is interesting. So RPA, the original the thought leader in RPA was a company here in the UK called Blue Prism. So they came up with they're like really the protagonist in this story in terms of figuring out that you could do this kind of stuff. And then in a very UK own goal sort of fashion, they decided they couldn't raise money. So they went public on the AIM, the junior exchange on the London Stock Exchange. And then, it's very hard to raise money as a public company. Like you can't do like financing rounds. And it just kind of sort of squandered the opportunity that it had. I don't think it was like as well run or as high growth oriented. And then the other ones were Autonomous Anywhere, which is in the US, and then UiPath. And I think out of those three, UiPath figured out the category,
Mhm.
was probably not the first entrant to that, was probably the later entrant to that, but was like the most driven, and the category was ripe for the taking. Number one in the category
Yeah.
doesn't mean first mover always, right? And that is a good example. Like it wasn't Friendster was before MySpace, right? It was a late entrant into the category. The category is still very vibrant. I think, and this is where like people will probably still say like founders need to stay in businesses. When the transformer models got really well understood and the LLMs came out, there's like a natural evolution for UiPath to use those tools and techniques, and I think that category is still there, right? If you take the categories not RPA, you take the categories just redefining workflows or automating workflows, we are in the early innings of what workflows are really going to look like inside of enterprises. There's a lot more automation to come, like a lot more stuff. Like it's not RPAs and form filling, which are like tip of the iceberg. No, and by the way, they were huge, right? Like that was a big industry, but like there's a lot more to go. And I feel like UiPath lost its kind of technology leadership edge because there's a giant $1 trillion company to be built. If you were the workflow automation company,
Mhm.
it's like there's another 2 decades
Mm.
worth of like stuff to build and kind of dominate. But they kind of pigeonholed themselves, I think, into just the RPA category. And I think these are not easy, right? Like a good example is like Amazon started off as a bookseller that went to multiple types of things besides just books, but then also built AWS, right? Nothing to do with books or e-commerce, right? And like is a massive business today where like, the categories just be like the plumbing and the infrastructure for like web. There's a lot of run to be had. But, like I said, like we are long-term believers in things. You want to buy into these things and then be part of that journey for as long as possible with them. And I do think people sometimes get a little bit too conservative sometimes with the market sizes of these things because like there is real market expansion if you get it right.
Mm.
You might have to change the way your mental model works, but like, that's part of the beauty of this stuff. And if you get the machinery working in your business and it starts spitting off cash, you get the ability to actually expand this way. And yeah, that's one of the reasons why we've had these discussions with a couple of our founders about selling out. Sometimes you get early acquisition offers if you're in the right place at the right time doing the right thing. I'm like, don't sell. Like, you get so much more surface area to go attack if you stay in business, especially if things are actually going in your favor. Like, there are big companies that can actually legitimately be built on the back of like some of these insights.
Mm. At the early stage, because you focus mainly on pre-seed and seed, from what I understand, what are most of the founding teams, do you think, what are the patterns that you see in the gaps that they have or what they're missing, being able to pattern match the companies that you've seen both succeed and fail?
And the biggest thing that we've come across and it's played out like over the last 2 years a lot, is I think our industry has gone, unfortunately, but it's very rational, has gone to this idea that the definition of success is the markup. I've set up this business. Who's going to write the next check, and where's that next check going to come from, and how much of a valuation inflection is that going to be, and what's the prestige level of the investor that's going to be that? And you find a lot of people solving for that. And the sidebar to this is it takes like $100 to $300 million to build a massive business, like to be able to take a company public and build the Figma of tomorrow, or the Amazon of tomorrow, whatever the example is. It will take you real dollars to get there. So you can't underestimate the fundraise. Like, you can't put it to the side and be like, that's a waste of time. Like, you have to have that perspective about who's going to write the check. And there is some real upside, is if you get a check from a brand name firm, a Sequoia, a General Catalyst.
Signaling for follow-on.
Exactly. So like, I'm not saying you ignore this.
Attracting the best hires, especially in the early stage when signals comparatively are tougher.
Exactly. So you need to be vigilant about this. And there's not binary zero, but I've seen so many people orient towards that. Whereas I think sometimes what you have to do, and I've had these long discussions at boards, is like focus on the customer. Because the way to get velocity in this business is to find customers, find the problems that they have, and then do that and kind of earn the right to exist for another few years. And venture money is a bit of a sideshow. Like, you need that as fuel, but you need your customers first and foremost. And where it plays out is like a couple of our companies were early pioneers in some of this AI stuff or deep tech type stuff, but the business model was services. It was not software. Like, and today, I think in an AI world, where you can understand that there are lots of articles now written about this, where you marry the AI with the services. So you have a bit of a human in the loop, but the more customers you get, the more data you get, the more you train the AI gets better and better. The less services, the more tech it is. It starts looking much more like a tech business than a services business. But if you never get the customers, you never get the data, you never advance further down the field, you're stuck more as a services business, And so people would be like, well, the VCs don't like, a few years ago, VCs don't like the services. So I don't want to sell the services. And I have big arguments with the founders. It's like, forget about what I say, forget about what the other board members say. What do customers want? And if you deliver to what customers want, and you're going to keep those customers, and they're going to be happy with what you're delivering, and you get the right to exist for another few more years, and you get revenue in the door, all of this stuff will get fixed over time. And I don't know how many people who think like this on a first principles basis right now.
It seems really meritocratic what you're saying, but I'd love to dive a bit into all of the incentives at play for a founder that pull them away from this, right? So, if listen to the customer and build what they care about, I get it. But at the same time, I need to think about not running out of cash 18, 32 months from now. Like, what?
So we have a good company, and keep it anonymous, right? That was stuck at about $1 million of revenue, like run rate. And the mental model for the founders, in many ways, don't know if they'd fully agree with me, but like, they wanted to get a big round from a good venture fund, and they wanted to kind of sort of be on stage at TechCrunch, Disrupt or something. Like, they wanted to be known as like people. Like, we had a long conversation about this, and I was like, what are you guys doing? What do your customers want? They actually went and did a roadshow with all their customers. They had a bunch of customers kind of stuck. ACVs were small. Retention wasn't all that great. And they went and talked to all the CEOs of like a whole bunch of people. And they came back and they had a very clear thought process about what customers actually really wanted. And I was like, but it was kind of a little bit more services versus AI. Again, it was one of these AI plus services business. I was like, just build what the customers, like, can we make money on it? Like, as in, like, will it be a money losing operation to satisfy the customers? No, like, we make a lot of money out of it. Just do what the customers want. And they started doing this. They went from $1 million run rate, they're pretty flat, to 7 to 18. And I think they might do as much as like 30, 50. And now they're getting a ton of people like knocking on their door wanting to give them money because the business is flying. And they're also like super free cash flow positive. I think if you are able to do this stuff, you will scale. And if you scale, a lot of things unlock. However, they were really lucky. They had money in the bank. If you didn't have money in the bank, then you have dual masters, right? Like you can only do what that's why I said these are not zero sum. They're not exclusive. You have to keep both hats on as a founder. And there's a lot of value in the signaling from some of the folks. But like, N8N is now a super popular business, right? It's basically the next generation Zapier for like, for like, especially for AI automations. Like that was a sleepy, and the business is flying like revenue wise, but that was like a sleepy and just raised like a big round at like 2 billion plus valuation, but it was a sleepy business for like a few years, right? Like, so there's something to be said for you've got to deliver to the customers, you've got to stay alive, you got to keep growing, and then you got to be in the right place at the right time. It's got to catch kind of lucky break.
I'd love to switch it up, Hussein, if it's okay, more on the kind of how to build a fund side of things. So I think you've raised 3 funds at the minute. It's probably a 4th fund coming at some point in the near future. Knowing what you know now, if you could have a conversation with Hussein of 10 years ago, what would you tell yourself about venture investing?
Yeah, I mean, I think in VC stuff, you have to, as a fund manager, you also have to be in the right place at the right time. I think, the biggest lessons for us were on fundraising more than the investing side. We did a good job, I think, on the investing side. I think on the fundraising side, there is so much social signal, which I underestimated, or maybe I knew it rationally and I didn't do it. Like the way people allocate capital to venture funds, because they have no idea who's good, who's bad. I mean, they know who the good ones are, like been around for a long time. Of the new group, they don't really know, right? It's very hard as an investor who is not in the industry, which by definition, most LPs are not in the industry, to know like what's actually good. And the way you solve for that is you look at who's following on, who's writing the next check after, a fund like ours would invest. And that gives you some assurance that the quality of the companies is actually really good. It goes a little bit further, which is if you're raising a fund, having those funds not just mark up your companies, but also be investors in your fund or do reference calls for you makes a huge difference. So this like social signal from the club of people who are at the top makes a big difference. It's one of the reasons why the venture market is a little bit unfair, right? Because it's an insular market. And if you're a total outsider, it's really hard you don't get those reference signals like from within the industry. It's very hard to kind of break out. I would have probably over invested in those. I probably underinvested in that.
What does that mean in practice when you say, what if you could have invested more in them, what would you do differently?
Like I would have spent more time with like some of the bigger funds and, built a tighter relationship with them and had them more proactively reference me, whereas I was like, if you just do a good job and do the job well, everything else will line up. And like I said, it's never that black and white. Like there is a lot of merit towards if that is how the investor on the other side, the LP, thinks, there's real merit in investing time and energy on doing what it takes to get all the social signal wrappers around you. So it becomes easier for you to raise money. If it becomes easier for you to raise money, you get more money to deploy, you have more ability to invest, more ability to do things. So like that I would definitely do. The second thing, it's kind of thematically the same, but it's on the investing side, is we have not been shy of doing independent deals. We've also not been shy about like
leading around and being the only ticket into the company.
We will do the rare earth minerals company, regardless of whether Sequoia is interested in it or General Catalyst is interested in it or Excel is interested, because like we think we've worked out the business. We're reasonably confident that you should be able to build a big business. It might be wrong if we're still venture at the end, but like we have conviction in our own ideas. We don't need other social signals to reinforce whether we're good pickers or bad pickers. Like we're self-confident enough, maybe like overconfident, but we're self-confident enough to make our own bets.
But to your point, actually having those, whether they follow on in the next round or they join you in this round, it ultimately may increase the chance that the company you're investing in is successful. It's not simply a signaling for you.
So where we've messed up is it requires 100 to 300 million to get these companies off the ground, like to real escape velocity, like 500 million revenue type businesses. So you can do the lonely part of the business and be contrarian or independent, however you want to phrase it. But if the market doesn't realize these are high quality companies and doesn't fund them the right way, then it's almost impossible for them to be able to scale and become big outcomes. So you still have to play within the confines of this industry and get people to support these companies.
Mm.
And again, I think we underinvested in that. Now, there are other funds that I think have massively overinvested where they do all the same deals. They're just like front running the things that the other people are doing, which kind of comes back to the question of like, do you actually even need them to be in the ecosystem at all, right?
Mm.
Like if you're just doing what everyone else is doing and putting a small token check alongside, you know, and maybe you're doing something good for your LPs, but like there is something to be said if you're trying to expand out this industry to having a different set of voices to increase more surface area, build out more companies. But you also then need to ally with all the bigger funds. And I feel like on both sides, we were so focused on the work and the fundamentals of the work and didn't pay enough attention to the industry that I would if I could rewind, I would spend just as much time with the industry
Mhm.
or spend more time with the industry to do this. And I think part of this is also 10 years ago, 15 years ago, there's no one to spend time with in Europe. There were no funds here. There's like Index and Axel. It was such a small industry. Whereas in the Bay Area, I think it's very natural to be constantly in the flow of information with other peer venture funds, but we didn't have that. And then like now that we do have that here, I'm so buried in my portfolio that I don't have the ability to go do all. I just have my time is more constrained today than it was 10 years ago.
Mm.
But like we'll get there. We think about this stuff now as well. Like, you these are all things that are good lessons for people. But the social signaling to get a fund off the ground, having now seen it play out a few times with friends of mine who've done and invested in that, makes fundraising so much easier.
Mm.
That if I knew that, like there's no reason not to do that.
Mm. One piece of advice that you would give for a first-time founder just about to do their fundraise?
I mean, it's no different for the founders as well. Like there is a signaling and social club, so I think a lot of these things, a lot of fundraising is social engineering. Like, you almost take a hacker mindset, you can try and hack the system, or you can socially engineer the system to get into the door of the building that you're trying to get into, or, there's a much easier way, which is the social engineering stuff. You know, you need the right people to be talking about you, to be making the intros. When I make calls for my founders, it is obvious to anyone who's then taking the call downstream from me or upstream from me at the bigger funds that I have like I'm a conflicted party.
Mm.
Like I'm selling something. I happen to be selling a company which I think is really interesting. I'm trying to get people to look at it seriously, but I'm a bias actor in the ecosystem because it's like a portfolio company where I have an economic interest in the company. The easier way for my founders, like in our own portfolio, to raise is for people in the industry to sell the company forward, right? So instead of me calling up someone at Lightspeed saying, hey, this is a really interesting company, it's like Sam Altman calling up Lightspeed saying this is an interesting company, right? And these things can be engineered to some degree. They take a lot of effort. You have to go build alliances. You have to have you have to be in the industry. But if you're in the industry as a founder and we can open up a bunch of doors so they can start some of these conversations, it becomes easier to then fundraise. And, if you're critical, you can be like, you're socially engineering some of this stuff, but that's kind of sort of how the world works, right? Like, because again, rationally speaking, if I pick up the phone, even if I know all these same people and I call them, like I'm a conflicted party, right? Like
Perception is reality.
you're going to discount what I have to say because I own some of this thing. I'm obviously going to say great things, but if a truly independent person says, hey, this is actually really breakthrough science, breakthrough technology, is getting it just underscores it in a way where it's neutral, right? Like they don't have an incentive to say any of those things. And so then you have to find those kinds of people who get what you're talking about and be like really genuinely excited or interested in what the company is doing and then kind of pass that information along to the venture community. And this community is so small and so much in the information flow that the minute that stuff happens to take place in the ecosystem, it will spread. And that's how rounds get done.
Yeah, I've heard this topic from other founders, like make a celebrity out of your customer. because they're your best salesperson.
Yeah, it's your customer. It depends on what if your customer is like old world companies, like industrial companies, you should do that just because that's good business, right? Because like you want your customers to love you, but that's not going to come back. But if your customer is Vercel,
Mm.
in dev infrastructure, like if they're talking about why you're a great company, that will carry weight and currency with a lot of the people who would be investing in that space. But this is an industry, and you have to play well in the industry to be able to do all this stuff.
Mm-hmm. What is the biggest mistake or regret, if you have one, about a decision that you made in Hoxton?
And the biggest ones that are the ones that we've passed, like companies that we've passed on. So we did 2 in the first fund for good reasons, but like really expensive good reasons. I spent a lot of time at Monzo when it was part of Starling, and the whole team left and they formed Mondo, and then they became Monzo because of the trademark. And one lesson for me is if I'm spending that much time with a group, I should probably write that's probably enough of a signal in and of itself. It may not be as easily documented, but like the way my mind works or the way like my engagement works is I don't spend time like this kind of time on things that I don't think have merit. So if I'm spending that kind of time on something, it probably has some merit, even if I can't figure it out. And we didn't do it. We didn't do it also because like we were almost end of life on Fund 1, and we hadn't raised Fund 2. And so to do it out of Fund 1, we would have to crush our reserves, which is take money, that we have allocated for the follow-ons of our, you could have broken the rules and done it.
Mm.
And then the even more expensive version of the same story, same regret, is we did the same thing with UiPath. And we were the first to see it, like, maybe not the absolute first because it then raised a little bit of money, but like we're the first to see it as it started hitting inflection.
Mm.
And
Would that be in the A or B?
it was pre-A.
Pre-A.
Yeah, and they
What
wanted
would be a valuation that you've been looking at?
So I don't know where it landed. I should ask Jem what he did it at. But it was pretty modest. They wanted 5 as a convertible note of some kind. Like that was the ask, and I think they were willing to take 3. We could have probably written 1. We didn't want to go through the broken glass of like being too poor to say you should really take 1 when their ask is 5. Like we didn't even engage, right? And to be fair, I don't think we fully grokked it. Like, like these are like I can make excuses for why we didn't do it in terms of the fund mechanics, but at the end of the day is we didn't do it because like we were too dumb to write the check, right? But we should have written the check like in those 2. They would have been massive outcomes for us.
What would that outcome have looked like?
I mean, our fund did very well. Like Darktrace and Deliveroo both returned like multiples for us, but like, we would have been one of these like rare like 20x net funds or something. Like, and it's too painful to do the math, but like they would have really made big out. I mean, Monzo with TBD because it's like it hasn't gone public yet, but like I think in both of them there would have been a massive additive factor, and it would have all come out of the same funds. Like, our first fund was only 17 investments and had 3 IPOs. So that's like a pretty good hit rate, but you add like those kinds of things, it's like a very transformative. It would have been a killer first fund. But yeah, those are the biggest regrets. And the big question for me is like, how do you not do that again? Because you can regret all this stuff like all day long, and there's like lots of lamentations like on what you could have done better. But like if you don't look at this as a growth opportunity,
yeah, we can only connect the dots looking backwards.
Yeah.
So ask you the question, what could you do differently next time?
So I think we needed more debate around the table. Like I'm a big believer that venture funds, if they can work well, and this is a big if, because a lot of partnerships like have fractures and don't work that well, and there's bickering and there's lots of negativity, and then those things don't work well. It's kind of like a marriage in some respect, right? Like the great marriages are fantastic, right? And they really amplify both parties. But to do this well, you need to have more robust discussion around the room, right? If it's only one person making these decisions, the chances for error are much higher because there's no counterbalancing force to make you rethink the assumptions.
Yeah, and we've all had these relationships in work or life, or relationships where 1 + 1 really does feel like 17.
Yeah. And
Now
that's,
you amplify the best of each other and cover the blind spots.
yeah, very, very, very hard to do. Like very hard to do in relationships, very hard to do in work, but that actually generates a ton of value if you can pull it off. And I think we were just too small as a firm. And again, we were like limited budgets, like limited fund size, like there are lots of reasons, but you can't lament the past. You focus on the future. We don't have those restrictions anymore. We're much bigger. So how do you create a really vibrant internal partnership and culture to be able to tackle this kind of stuff so that you minimize your ability to make mistakes?
2 questions from me, Hussein. This has been so much fun. So thanks for the openness. First question is, what is one tool, product, capability, could be anything, I'll intentionally leave it blank, could even be a book, that you found in the last, let's say, 6 months, a year, that you think people should absolutely check out?
The most fun that I had, like a book that I had a lot of fun reading, it's totally an airplane book, is a book called Careless People. It's a former Kiwi diplomat who talked her way into a job at Facebook in the early days. Obviously, a very disenchanted employee at this point. And she's no longer at Facebook or a Meta, and writes in a kind of tell-all tale about some of the stuff that we kind of know about, like, which is like the disregard for like misinformation, like, but it has this insider's view. Obviously, has completely torched her career in tech by writing this, but it is, you cannot read this book and think of Meta in the same way again. Like, and it is, I don't know how accurate, it seems directionally accurate from the little bits of stuff that I know about the company. I don't know if it's malicious. Like, I don't think there was like malicious programs inside of Facebook to do anything, but there's such a blatant disregard for what the consequences are. It became famous because they tried to stop the book from being published. So she writes this book, it's like super under the radar, and then they like sued to try and stop the book from being published, at which point people started writing about it.
Yeah.
And then a fellow board member gave it to me. And I read it on the airplane. I was like, and he knows her as well. It was like, you should read this book. And I read it. It was it's a great read of like, there is something to be said is as you get bigger in life, in anything, right? As you get bigger in business, I would argue that you have an increasing moral responsibility on your shoulders, partially due to the fact that you are now a bigger player in the industry, and you can shirk it and ignore and say like, I don't actually have this, like this responsibility is fandom. It's not a real responsibility. Like there's no code that says I have to carry on this responsibility, which is kind of sort of,
Or you could feign that you're smaller than you are.
you could feign that you're smaller than you are. Or you could like kind of own it and be like, okay, like that's the position that I'm now in. Like I should be taking this much more seriously. I probably fall into the latter bucket. But you know, this book probably, you know, it's clear from the actions of the company that they really don't care.
Last question, Hussein. So imagine we could fast forward, let's say 30 years in the future, and you and I are sat next to each other on the proverbial deck chair, let's say. And we look up at the stars in London, and I turn to you and I say, Hussein, what was it all for?
This job is fun. Like I enjoy the job. So like I do the job. I mean, the money is a scorecard to some degree on how well you're doing the job. It is not for the money. If I wanted to retire, I could retire. Like, you know, there's a lot. I mean, I'm an older parent to a very young kid, and I'm like getting close towards 50, and my child's 3 years old. There is a real like dichotomy right now. Is like, how do I maximize the amount of time with him? Because I do think as you get older, you realize, and there's work, and like I care a lot about work, but I also care about family. And, you know, these two things sometimes are incompatible because time is sadly zero sum. And so like I leave this weekend for New York. I have to go do this because we're trying to recruit another partner into the firm. So like I'm going to go see them. And I'm coming back again on Wednesday, and I have boards, and I'm flying to something else on Thursday night. So like basically for the next 7 days, I'm not really going to see them. So like I would hope 30 years from now, my answer is not I did really well professionally. We're talking about professional stuff. I would hope we're spending just as much time talking about some of the personal family stuff 30 years from now. It's not a dimension you would normally talk about at work, but like I would feel like a failure if it was all professional success. Like there is something to be said for like spending a bunch of time with family and investing in all of that.
So we're going to do episode 2 in 25 years, and we're going to talk about family.
And that is not easy. I take some comfort, like Bill Campbell, who was the CEO or chairman of Intuit and was like the coach to Larry Page and Sergey. Like he coached a kids football team like every week. Like, and Ballmer at Microsoft used to coach a basketball team of like little kids every week. And like every week, no matter where, I mean, again, some of this stuff is they have a little bit more resources, but like they would fly back to make the game. Like, I don't know if I'm at that level, but that kind of commitment back to community or back to family alongside of like super high achieving, like these are both like super high achieving people, like much more achieving than I am. Like that's a win in many ways, right? And by the way, like within their circles, Bill a much wider circle, because this is reasonably well known in Bay Area, all knew this about him. Like that's a positive. I don't know if I could get to that level, but like as an aspiration, and to me, that's a good aspiration.
Let's aim for it. Hussein, this has been so much fun. Thanks for coming on.
Thank you. Good to be here.